Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Ryan Detrick, Chief Market Strategist at Carson Group. He joins me to discuss why it is a first time for everything type of market. It is great to see you, Ryan. Welcome back to Trade Talks.
Jill, thank you for having me, and happy March Madness.
And it has been March Madness in many ways than one. I mean, you argue that's been the 2020s in general. And I saw you put out there on Twitter, you were saying this is a first time for everything type of market. What do you mean by that?
Yeah, I mean, so many different things, right? You've got a Fed that was so aggressive. Now they're going to maybe slam on the brakes. You got an economy that's maybe going into recession. Maybe it's not. They look at some of the recent data. We're not going into recession, but everybody's talking about the credit crunch that's coming out. So there are just a lot of different things, a lot of different volatility. Last point on this, stocks have done pretty well all in all the last couple of weeks with all the bad news. Likely going to be up 2 weeks in a row. But what I'm talking about, the first time for everything bond market. This is like the most volatile bond market we've ever seen. I mean, the 2-year yield every day I look is moving 20 and 30 basis points. Just for the listeners to know, that's an extreme move. This is like the most volatile bond market we've almost ever seen, Jill.
I also want to cover sentiment here. It feels like there's a lot of doom and gloom out there. Virtually every survey you read, everybody's negative.
Well, you're right. And from a contrarian point of view, I think that's a good thing because, again, the news has been bad. Financial crisis, well, not financial crisis, strong way to put it, banking crisis, banks going under, trouble in Europe. Yet, you look at the sentiment polls, we're seeing some of the lowest number of bears or highest number of bears we've seen all year, lowest number of bulls seen in a while. There's one called the Bank of America Global Fund Manager Survey. All you got to know about this one, investors are like as bearish as they've been in 20 years. Now, Jill, what does that tell us? Well, a lot of bad news is priced in. If we can get any good news, we think we could because the economy's, I think, on better footing than people give it credit. That could be a positive thing for stocks, which, again, just don't want to go down. It frustrates a lot of bears to say, you know what, stocks have been up 2 weeks in a row since all the banking stuff started. That's frustrating to the bears. It's frustrating to the bulls too because we're not going anywhere. But I think we're trying to carve out a low here with this very low expectations and market sentiment.
Why are tighter credit conditions a substitute for rate hikes?
Ooh, that's a good question. Yeah, I'll put my CFA hat on, although I don't have a CFA. So, you think about it, if you're a bank, right? Are you really going to loan to that questionable person right now? Because, the regulators are watching, everybody's watching. Probably not. So in a way, why does the Fed hike rates? To slow things down. When you have this credit crunch and all the trouble that we've had all of a sudden, banks are going to slow things down because they're not going to lend as much because they're a little questionable, worried about the regulators and can this person pay me back? So in a way, people much smarter than me have been saying what's happened has been like 2 to 3 25 basis point hikes. So it's almost like doing the Fed's job for them, that it's slowing things down. Now, trust me, the worry things slow down too much, then you're in a recession and nobody knows what's going to happen. But again, if we can avoid a recession, which we still think is, maybe 3 out of 4 chance, we don't think a recession is imminent like so many other people because the consumer is so strong still, although things are going to slow down because banks aren't going to lend like they were.
So with that said, what are some potential scenarios that can come from the Fed?
Yeah, well, I mean, I think the number one is just the one more rate hike and that's it, right? I think that's probably the one. That's what the bond market is telling us. Bond market saying, Fed, you are about done. And the bond market sometimes can be the bully when it comes to the Fed. So that's kind of the one. And the other is inflation. I mean, we've all talked about inflation. Inflation's coming back quickly. And as things slow down and this credit crunch, usually those are deflationary. Now, you don't want massive drop in inflation. That can almost be a bad thing. But inflation's coming back down, Jill. So that's maybe one less worry that we had this time, just a month ago, let alone, 3 or 4 months ago.
In the absence of a Fed meeting until May and earnings aren't until mid-April, where do you think investors are going to be focused?
Yeah, well, I mean, we're looking at all those regional banks, right? There's some of the well-known. We watch it every day. What's going on in Europe? But I'll just say this. You mentioned March and April. The second half of March, historically, Jill, has been quite bullish. You look at April in a pre-election year, up 17 out of 18 times going back to 1950. So again, you don't blindly invest in these things. But as an investor, with all the negative sentiment, with trying to carve out a bottom, and the fact stocks aren't going down with all these terrible headlines, I think I'd be open to the idea of a springtime rally. Second half of March has been pretty good so far. April's usually pretty good, so just be on the lookout for that surprise rally in April.
All right, Ryan, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.